Guest says oil prices will remain high and could still spike to $120 a barrel. He also dares to say that we are in an energy regression and not an energy transition. Let's bring in Paul Sankey. He's the lead analyst at Sankey Research, of course. Paul, welcome.
Hi, Kelly. How are you? I have to say, a couple of times ago, I was on and one of your viewers complained about my appearance. So he asked me in future to wear a jacket and tie. So
I appreciate that you treat them with the respect that they deserve. Paul, there's so much I want to talk about in the energy transition piece. But before we get to that, let's just talk more near term. 120 a barrel, is that only if there's an invasion? And if there's not, then where are we landing?
No, the 80 to 120, what we were saying is that the oil price is getting squeezed into a higher range, which is 80 to 120, with 120 being the point of demand destruction. As you know, the oil price is very high in certain countries with weaker currencies, let's say Turkey or Brazil or India. So it is a concern even at current levels. But American demand, as you know, is very strong. And so we're not seeing the point of demand destruction even here at over $90 a barrel. The 120 is the level we think you will get U.S. demand destruction.
As you probably know, Cities Ed Morse, who we spoke to about a week ago about oil prices, thinks we're going to be landing in the 60s by the end of this year because he basically thinks more supply is going to be coming online. Is that a likely scenario that people should consider and take seriously?
Well, Ed obviously has tremendous experience, and as a voice, I think he loves to be contrarian as well. So it's a contrarian view, and I think we're glad he's out there because it's very worrying when everyone's bullish. It'll be interesting to see. We've got big results coming up. We've just had Continental, a major U.S. E&P, down 8% today on higher spending.
Wow.
We've got Devon tonight reporting, and we're going into a week here of very significant earnings reports. Pioneer tomorrow, some of the real signature names in U.S. E&P. If we get strong discipline from these guys, I think you're going to find that the market's tight on an ongoing basis, and we don't get a huge surge in supply in the second half. And this is all X any potential invasion by Russia.
Absolutely. Let's dwell on Continental for a moment. Maybe we can show the chart. But what does it tell you that the shares are down sharply on those increased spending plans? How is that going to be taken by the rest of the industry?
You know, we used to see this with refiners. They would announce significant capex plans, and the stock would get crushed on the day. And eventually, the likes of Valero got the memo and simply, became very capital disciplined and very organized about cash returns to shareholders. So I'm happy when companies lose discipline a little bit to see the market really pound them. Of course, Continental's caught a big down day for oil as well today, but it's much underperforming because of this concern of higher spending, absolutely.
But in other words, is their stock price reaction actually bullish for the price of oil? Does it mean it's going higher? If those major companies who are out there saying we're going to increase our spending are being met with that kind of sell-off, does that mean we're not going to see a big supply response?
Exactly. That's exactly my point. And so we want this capital discipline because the marginal price of oil is set by U.S. exploration and production companies. However much they grow, however much they produce incrementally, essentially sets the price of oil. And so the more disciplined, the higher the price.
All right. So let's end. You like Chevron, you like Exxon, also Devon and Diamondback. Why these in particular?
Devon and Diamondback are just two very good quality asset, high quality assets, high quality management, high quality strategy regarding buybacks and cash return. Because obviously the other part of not wanting the companies to spend a lot is that we want to generate, high dividends and high buybacks, because ultimately, we are in the next 20 years at the end of the oil age. We believe these companies should go into effectively orderly liquidation and essentially turn themselves private as by far the most attractive thing they can do for shareholders. And so the more they hand back cash, the more we like them. And those names are all very disciplined in this regard.
Fascinating. Everything that you said sums up what's going on in the energy space right now. Paul, thanks again for joining us.
Shepard Smith here. Thanks for watching CNBC on YouTube.